Hey everyone, it is Tuesday, and that means we are doing That's Our Two Satoshis live. For those who have never done this before, we talk about crypto. We've been doing it every week for almost 7 years now, 6.5 years. We got a blog. We write about the markets every week, ar.ca/blog, where you can read about it or you can tune in every Tuesday afternoon and we will talk about it. I am Jeff Dorman, Chief Investment Officer at ARCA, joined this week by David Naish, who has been at ARCA basically as long as I have, man. It's been a long run.
It has been.
So David Naish, former family office investor and current venture portfolio manager at ARCA, and has done a lot of things in finance and tech along the way. And in addition to hosting his own podcast, Base Layer. So David, thanks for jumping.
It's my pleasure, and I'm glad we have our hair still being in this space for that long. It is a real challenge over the course of the last few years, especially with all the things that we deal with in this space. But I'm glad to be with you.
Some people will turn us off for having hair. I think they like the bald men in crypto who are driving things forward. So ignore the Mets signs behind David. He is a smart guy, and
Easy. Come on.
All right. So last week, David, let's talk about the markets really quick before we dive into what really matters here. So markets were great last week, right? I mean, we had a pretty rough April. Most things down double digits, exhibiting 2, sometimes even 3, 4x beta to Bitcoin on the way down. Last week, we got a little bit of a reprieve, largely from the FOMC, sends bonds up, crypto up, equities up, the dollar down, everything kind of moving in lockstep. But even though prices were higher, even though it was a good week for our P&L, not everything was super copacetic in crypto land. We touched on it last week a little bit. I'm going to touch on it again. What is going on with these new issues? And what specifically, again, I focus more on the liquid markets. You focus on the private market, specifically from a private market lens. Why are these new issues failing? What's going on? What can we do about it?
It's something that a lot of people in the space are talking about in different chat rooms, publicly on Twitter, and it has the eyes and the ears of a lot between founders and between investors in the space. I think what happens is that if we look back over the last 7 some odd years, as you alluded to, from our time when we started in the space, what happened is that there were a few funds in the space that effectively, when they received their tokens in terms of the investment that they made, there's a token generation event, a TGE. They received their allocations and promptly then started to sell the tokens in the market. And so there's a lot of downside pressure. This prompted founders in the space over the last 5, 6, 7 years to really start looking at mechanics to change the ability for those to do that. That's why we started to see this 10% allocation at token generation event. That's why we started to see the vesting schedules. That's why we started to see the cliffs. All of these mechanisms to effectively ensure that there wasn't this massive downside pressure right when the token went live, either on DEXs or centralized exchanges. And so this has been one of the big problems in the market, in my opinion, is that you have all of these mechanisms in place when you really should just have effectively a free market where the market price.
But hold on, before you get to that, though, you're saying that we used to have problems with these token generation events and tokens going straight down because of these unlocks and because of these vesting schedules. Fast forward to today, we're still having the same problem. Tokens are going straight down. They're being listed on Coinbase and Binance.
Yep.
We got all these rules that Coinbase and Binance set in before a token be listed,
Yep.
and then they still go straight down. I mean, I wrote specifically in the piece. I wrote, I run a liquid fund. I've been doing this for 6.5 years. I used to buy every new issue in the debt and equity markets, right? If it was a new issue, I knew it was going higher.
Yep.
I wouldn't touch a new token on Coinbase or Binance. They go straight down.
Yep.
So all these protections and mechanisms you're talking about, like, they're not working.
Yeah. So what happened is that you still have that 10% that's coming out. So what's happened is that you have investors out there, but once they get their 10%, they're immediately selling that. So you have downside pressure there. You also have, with these new issues, you have low float, meaning that you don't have a tremendous amount of liquidity out there in terms of the market. So they come out with low float, and WorldCoin did this last summer. There was low float, there was a high FDV, and you have more market makers than you have investors on your cap table, basically, trying to, drum up, some sort of support for the token out there. And so that's been another very large issue systematically in the system, is that you have low float, you have high FTVs, and you have all of these market makers that are trying to effectively pitch and trying to get people to buy up the liquidity there that's scarce.
But let me push back there as well, right? I mean, you go to the IPO market, which has been around for 100 years.
Mm-hmm.
Those are basically low float, high FTV launches as well, right? A company, when they actually IPO and sell proceeds to the public, it's a fraction of the stock. So it's not
Right.
just the low float that's the problem. It's the fact that the other part of the FTV that is not liquid either becomes liquid way too fast, or it's this
Yep.
massive overhang,
Yep.
or the market makers, in my opinion, just have no skin in the game and therefore don't really care where this thing prices because they're just getting tokens for free from the projects. Like,
Yeah.
there's something else besides just the low float, high FTV.
Yeah, there is more to that. At the end of the day, as you said, I run our venture book and I talk to our venture funds every single day, other, GPs out there. And, there's a few things that, bother me. One, at the end of the day, as I said, again, we shouldn't have this 10% of TGE. We shouldn't have these, vesting schedules. There should, as you alluded to, like the IPO market, there should be a lockup period of 90 or 100 days, in my opinion, where, early stage investors don't sell. They can't sell. They're locked out. Let the market price the asset. Have, instead of just the market makers that are using the last valuation of the last round that was raised, let the market actually price the assets the way that it should. There needs to be this kind of component of what you have in the equity market, like a book runner, where you have someone or something out there, as I said in our writing, could be not only people, but it could be AI, it could be bots, it could be, some sort of an AMM type of mechanism that effectively tries to price the asset better than just using the last valuation of the last private round. And so, I think that needs to happen. I think we need to have that kind of bookmark, book runner type of mechanism. And I think, for all intents and purposes, we need to have more of that 90 or 100-day lockout period after a token generation event, where you don't have the early stage investors potentially going to the market and selling their assets right then there to create that immediate downside pressure. Why I think this is important, and this is a really sticking point for me, is that as an early stage investor, we have information asymmetries. We are with these projects and founders from the first earliest days from their maturation. We know what they're trying to build. We've helped them hire people. We've helped them with compensation planning. We're supposed to be knee deep and 7 inches wide into these things. And so for the market to see large, funds and small funds selling day one, that gives a negative signal out there. Maybe something's not right. Maybe this isn't so good. If their earliest investors are selling from day one, maybe this is not such a great opportunity. And so
Well,
I think it's causing a big problem.
let me go even further than that for a second. So, I'm a big believer in free markets. I'm a big believer in the invisible hand, that markets get to the same level regardless of how you get there, right? So if a
Mhm.
token is going to be ultimately worth $50, it doesn't really matter if it starts at $2 and goes up to 50, or if it starts at 100 and goes down to 50. It's going to get to 50 regardless. The difference is that the path function it takes has a huge effect on the sentiment and on future interest thereafter. And when you have, again, market makers with no skin in the game, they don't care if they go out there at 100 and it goes to 50 because they're not taking the losses, right? It's the founding team that's taking any losses there. They gave the tokens for free. They don't care. It's the retail investor who buys it at 100 and rides it down to 50 who takes the losses. And then they get angry and then they never come back. And you don't build what crypto tokens are supposed to do, which is build the evangelist and the power users and the community.
Right.
Like I said, ultimately it's going to get there anyway. But the flip side is, if you price it at $2 and all of a sudden retail makes money and then they're happy and it goes up to 50, yeah, maybe it cost the founding team a little bit of money, but you built your community, you built your power users, you built your evangelists, you make people feel good, and it gets there anyway. And moreover, most of what you're talking about right now is the private investors, the early venture investors, they have information asymmetry. You need to put a lockup on there to prevent them to sell. You know what prevents them from selling? When you price it at $2 and it's worth 50. Guess what? They're not going to sell. In fact, they're probably going to buy more. But when you price it at 100 and there's no skin in the game for anyone, of course they're going to sell because it was priced wrong. And that's why these things are going down. You don't have anybody doing independent work ahead of time about what these things are worth, independent research. You don't have a book runner. You don't have an investment bank, like you said, because the SEC has largely shut that down. You can't make it look like it's an offering, even if you're not even selling tokens. Therefore, you can't write reasonable research or put anything out there about, hey, this thing's really worth 50. So don't buy it if it comes out at 100.
Right.
But, I think the venture community, honestly, is taking unnecessary heat for their role in this. It's not them, unless they're the ones advising the projects. It's the projects who are getting bad advice from someone in terms of how they're giving it to market makers and listing it. It's the market makers who are listing it at ridiculous prices. It's the exchanges, Coinbase and Binance, for allowing this nonsense to happen. You can just say, yeah, go ahead, you can list it, but you're listing it at this price because this is what it really should be worth.
Right.
There are people who are absolutely need to have fingers pointed to them who are doing this wrong. And as a former capital markets banker, I can tell you they're doing it wrong. There's a reason league tables exist. League tables show what is the price after day 1, after day 2, after day 7, after day 30, after day 90, because it matters. It matters to put things at the right prices that actually trade up and are supported, not just something that entices the early venture investors to sell. And if for some reason they don't sell, hey, congratulations, look, we didn't sell. Well, who cares? You shouldn't have.
But again, at the same time, and I agree with all those points, at the same time, as I said again, having so much information from these projects and these companies from the earliest days, when they go into their token generation event, when they go on Coinbase, when they go on Binance, with all of that information, we should be also investing in these things when they go out with their token. And you're seeing the converse on that. You're seeing the opposite. Now, again, I completely appreciate my peers who are going to say and scream at me and say, well, we should be allowed to have the ability to take on some return from the risk that we've taken on in the earliest days. Absolutely. We all should be able to have some sort of level of return taking when there's been such amount of risk that we've taken from those earliest days. But I'm saying it shouldn't be the first day. It should not be that first day, because that just sets a very bad negative signal to the entire market. And so there should be some sort of alteration. There should be some sort of mechanism that it should say not on the first day. And I'm fine with that as a venture investor, and one that has, companies that are going through the same type of, opportunities in the future. I'm fine with that. I don't want to see that the first day, and I don't want to see all of these weird mechanisms that are being put in place to try to prevent that kind of activity. It, again, to your point, it doesn't enable a free market.
Yeah. I mean, quite frankly, I'm tired of finding all these reasons to prevent people from selling. How about finding reasons to get them to buy? That's what you want. You want to create buyers, not prevent sellers. And I think just all of the players involved have just been misguided and been given terrible advice over the years.
And to your point about regulatory, one last thing about regulatory is that, the Marketing Act, stipulates that, venture investors like us who have all of this information, have been backing these companies since day one. We can't really go out and tell people why. We can't really promote them. We can't really say, this is what this project is doing great. We can't do that. So to your point about, educating the masses out there, we're prevented from doing that again because of the regulatory side.
Okay, so you mentioned one thing to fix this, obviously, which is no selling on day one. What really matters here is not just the finger pointing, but how do we fix it? What are some ideas that you have? Again, knowing that you are, from a P&L standpoint anyway, at least short-term incentivized to take profits as fast as you can. Longer term, for the sake of your investment, as well as longer term for the health of the industry, this is obviously not working. So what are some fixes? What are some things that you're thinking about that could help some of these new issue processes?
Right. So I think immediately, when we're going to be talking to our teams about this as well too, I don't think that, I think we should learn from mistakes. WorldCoin, when it came out was, there was a lot of issues with that. Now, again, they're not alone. I'm not picking on them. That was one issue that came out that was very well, obviously pointed to. But we should learn from those mistakes. We shouldn't replicate them over and over again. So we shouldn't have low float. We shouldn't have this high FTV. We shouldn't have all of these market makers coming in, from day one. So that's one thing that we're going to be talking to our teams about, is limit the amount of market makers. If you want to have one, have one. Don't suppress all of this liquidity like that. That just it's nonsensical and doesn't work. So that's one thing. As I said, a second thing, from a venture perspective, if anyone wants to build some sort of an automated AI type of bot or machine, learning algorithm that can effectively do what a book runner does, in a more, kind of Web3 kind of component way, I'm going to back you, because we need that. So that's the second one. And then the third one, as I said again, is, instead of day one, maybe we make it 90 days, maybe we make it 180 days, But I think we should learn from what, the equity markets have done in terms of IPOs. There's, as you said, again, 100 years of backlog of history from the venture, days to the early IPO days, where the likes of Arthur Rock and all the famous VCs in the world didn't immediately sell their shares of Apple and, all the other, amazing companies that they backed once it went, to an IPO. I think we should learn from that. I think we should adapt what we've been doing, and we need to start making some changes. We can't keep doing the same thing over and over again and expect new, something miraculous to change in the market.
Yeah, I think you're right. And look, I think, again, you come at it from a different perspective maybe than I do, and I think that's good. I think you're being a little more diplomatic than I am. I have no problem pointing the fingers to those who I think are at fault here, which, again, I'll say it again, it is the exchanges and it is the market makers. But that being said, I think you're right. I mean, there are some obvious solutions here. I think founding projects, obviously, sometimes we take for granted that these guys are, they're here to build great tech and they're here to run a business. They're not necessarily finance experts or capital markets experts. So I don't expect them to know this, especially when you just have, so much bad precedent out there that is being, pitched to you as this is just the way it's done. Yeah, it's not. It's not the way it's done. It can be done differently. And I certainly would welcome any projects and or market makers and or the exchanges to reach out to us and certainly lend a helping hand in a better way to do this. David, I think people will go to the blog and probably read the rest themselves. There's a lot of great charts in there, a lot of great data. We also shout out to a lot of people who helped write this in the sense that we took some of their information. Guys like Hayden Adams from Uniswap and Regan Bozeman and plenty of others who have also been on this train talking about it. So go ahead and check out the blog when you guys can, ar.ca/blog. David, what else do you want to talk about really quickly? Closing thoughts as well as how people can reach you.
Yeah, closing thoughts again is that we, one of the other things that we need to be mindful is the supply and demand balance right now. Is Regan also, as you alluded to, annotated, and Thor and a few other folks on, crypto Twitter noted there's a huge amount of supply coming to the market. The demand has been fairly low. So we need to be very mindful of that. So I think it's something that you and I and the rest of the team will be obviously writing about in the near-term future. And the way that you guys can get in touch with me, either on Twitter at David Nage, or you can obviously reach out to us on ar.ca and contact us. If you're a founder, you're looking for potential funding, we'd be happy to talk to you.
Great. David, thanks again. And for those listening, appreciate the time as always. Disclaimer, because I forgot at the top of the hour, none of this is investment advice, as always. But you can certainly ask us questions individually. Find us on our website, ar.ca. Find us on Twitter. I'm at jdorman81, and we'll be back again with another topic next week. Thanks, everybody. Take care.